The non-banking financial companies (NBFC), this sector has since the emergence of the COVID-19 pandemic faced numerous issues that has threatened to impact operation on both the collection and the disbursement side. So the need of the hour has clearly been a push towards the digital aspect more than ever, being pushed in the large by mobility restrictions. So in this session, NBFC had introspect, debate, and emphasize on the need of rebuilding businesses digitally and prescribe the recipe for NBFC to reach their status quotient in the past COVID-19 world without having to distance away from customers. To guide us further on these lines, we are joined by a panel moderated by Amol Dete, ETBFSI. Please, Amol, if you could introduce the panel and take it ahead.
Hello and welcome to ETBFSI Converge. My name is Amol Dete and welcome to the third day of ETBFSI Converge. I'm so sure that you enjoyed the first 2 days of ETBFSI Converge with remarkable insights and the best speakers from not only India but also from different parts of the world. Thank you so much for joining us today as well. And I guarantee you that even today's day will be a very meaningful and enriching day for you because we have NBFC and FinTech as a discussion points today. To begin our day today, I'm going to talk specifically about NBFCs, the changes and the challenges that is happening in the NBFC sector. And I have the best speakers, the best leaders from the industry with me. The topic of today's discussion, which is the first panel discussion of the day, is reinventing business models. And I have with me Mr. Hemant Kanoria, the chairman of Shri Infrastructure Finance. Mr. Kanoria, welcome on the show. I have Mr. George Alexander Muthoot, the MD Muthoot Finance. I have also Dr. Kshama Fernandez with me, the MD and CEO Northern Arc Capital. I have Mr. T.T. Srinivas Raghavan, MD Sundaram Finance with me. And I also have Mr. Sachin Pillai, MD and CEO Hinduja Leyland Finance with me. So thank you, dear speakers, for joining us. Thank you so much for taking out time and for your participations. To begin with, Dr. Fernandez, I will come to you, and I have actually one common questions to all of you, but maybe ladies first. So I will start with you, Dr. Fernandez. And the question is, in the pandemic time, I do understand the NBFC sector was going through major changes and challenges even before pandemic, but specifically the impact of considering the impact of the pandemic, how are you reinventing the business model specifically for your company?
That's right. Thank you, Amol, for that question. And yeah, let me just say that it's been a challenge. It's been something that nothing had prepared us for. And in some sense, I think a lot of us, including Northern Arc, we've been thinking on our feet. And in terms of reinventing the business model, let me just say that I think one of the big challenges was really simply connectivity. And in that sense, Northern Arc itself over the last couple of years had spent significant amount of time, capital, building the digital interface for us. And in some sense, when the whole lockdown happened, it was almost instantaneously. We could switch from being brick and mortar, physical, dozen meetings every day model to instantly getting to a world where we were operating remotely. So that was very, very important. In terms of how are we dealing with the current situation and how is the model evolving, I think there are two things that we are largely doing. I think we continue to have confidence in the underlying sectors that we focus on. Northern Arc focuses a lot on small to mid-sized entities that really deal with challenges of the underbanked in India. We continue to have very strong confidence in many of these financial institutions and underlying sectors, and we haven't changed our opinion about the promise of those sectors. So we continue evaluating that. Nothing has changed there. Given that a lot of our business is largely institutional, it's structured and so on, we don't particularly face the challenges that many retail institutions are facing. So collections haven't been a challenge, a moratorium hasn't been a challenge. We haven't had those many challenges in terms of either liquidity. There has been no challenge on the asset side. I think the biggest challenge has been growth in some sense, and that's what we are trying to grapple with, getting a sense of what will happen going forward. When the moratorium period ends, how will growth happen? How will sort of the new asset build up happen? I think those are the kind of things that we are currently trying to grapple with. But absolutely, I mean, been as challenging for us as anybody else just to deal with this new state of the world. I think the fact that we were technologically ready to launch really was a very, very big strength and a positive for us during this period.
Okay, thanks, Dr. Fernandez, for setting up the tone, and I will move to Mr. Kanoria. Sir, just tell us, how are you reinventing the business models, because your sector is also very important in terms of the economic growth.
What had happened for us was that in the infrastructure financing side, last 4-5 years we were reducing our portfolio because of the changes in the environment on the infrastructure project financing. So we are focusing on the equipment financing side. And after the 2018 problem and episode of ILFS, it definitely affected, especially those companies focused primarily in the equipment financing and project financing space. So therefore, we were facing an interesting situation. And after the COVID, the situation has become even more interesting. Okay. And we had introduced the co-lending platform with the banks, etc., to see that how do we share the risk, reduce our portfolio. And fortunately, we had never borrowed short-term and lend medium or long-term. So we have not had the asset liability maturity mismatches and all, which has been one of the biggest problems in many of the NBFCs. And so therefore that we have not got into that problem at all. But definitely most of our clients now, because we have been financing into those particular areas where construction companies, contractors, healthcare companies, everyone to a certain extent has been affected with the pandemic, and their businesses have also been affected. Right. When we have faced, it is not that the asset quality has deteriorated. We see contractors and companies having equipments, but then many of the places they are not in a position to deploy the equipments because migrant workers who are working have gone away. So therefore they have to bring them back in many of the areas. The government has again started making some payments gradually. Some of the state governments are still having problems. So I'm not saying that there are no problems, but at the same time, because the asset quality is good, there would be, many of our clients are coming from moratorium. So therefore we are, and RBI has also announced certain policies on the refinancing under the COVID package. So we would be extending that also to our customers. At the same time, on the liability side, because we do not have any short-term liabilities, so therefore there is no pain as such. But definitely we have to work along with our institutions to find out medium to long-term solutions on the liability side. And I think that this is one of the major issues which will remain for companies who are primarily financing businesses and companies which are financing consumer durables or consumers, etc. also. So they have a blended portfolio, whereas our portfolio is primarily to the equipments and in the infrastructure sector.
Okay, thank you, Mr. Kanoria, for that note. Mr. Pillai, what is your view? How are you overall reinventing your business model in the pandemic time?
Yeah, thanks, Amol, for asking that question. Business model, if you ask me, remains the same in terms of the customer segment focus, the asset classes that we look at, our network that we have put in. So all that remains the same. But the way we approach the business is, kind of taken a change because of obviously this pandemic is kind of brought in lockdowns and social distancing, which are the new norms. And businesses across the board are impacted on every aspect, as this pandemic is more of a human problem rather than, in the past we have seen problems coming out of economic downtrend or financial downtrend. Given this background, at an organization level, what we did is we looked at each of the processes and looked at, is there a way for us to substitute technology over human intervention? And then looked at, various, whether it is on the client origination side, on the risk underwriting side, client servicing side, even internal processes of employee onboarding or HR related processes in the interim, we looked at how it can be digitized. Obviously, the proliferation of smartphones and mobile-based apps, usages were already, coming up over the last couple of years. We always believe that the customer segment that we focus on, which is self-employed, largely bottom of the pyramid, the adoption, pace out there for technology would be a big question. But we were pleasantly surprised in this period where we saw a 10 times increase of usage of our, for example, our customer service apps, Connect in this period. So that kind of gave us, inputs to say that, in these time periods, customers are also willing to change their approach and, adopt technology. And that was I would say, a blessing in disguise. Secondly, this pandemic has also helped us in, rewriting some of the risk conventions, because the propensity of a location or cluster which is impacted by corona, or, virus have impacted the dynamics of the demand out there, the local economy, the customer behavior. These locations where movement of human and goods are, largely impacted. Even a good customer staying out there is today kind of got hit, and the risk probabilities, have got enhanced. The adjustment and ability to read the longevity of such a risk is a new learning, and that as an organization as well as an industry, we are kind of dealing with. I would say that to the extent possible, we are looking at substituting human intervention by tech, redefining our risk models by taking into consideration the risk emanating out of this pandemic in the overall appraisal process, refining the focus on the asset categories which we are, seeing a bounce back. For example, asset categories which are more, related to rural, and I'm here talking more from a vehicle perspective. Classes like your tractor, two-wheeler, small commercial vehicle, car, used vehicles, etc. We are seeing traction picking up, and therefore there is a bounce back happening. So we are looking at focusing on that. And certain asset classes like your medium and heavy commercial vehicles, construction equipment, we feel would, would take some more time to bounce back, and therefore these are susceptible to higher risk in the interim. So we are taking steps to address that. So I would say model remains the same. However, the approach towards the business is definitely, changed because of this pandemic playing out.
Very well said, Mr. Pillai. Model is the same, but the approach is different. In fact, that's what I can see in a lot of financial institutions now. TTS, sir, I will come to you. You're one of the important player in the South. So how are you, looking at whole, ecosystem right now, and how are you inventing the business model at your company now?
I think reinventing, business model change, I think are all sort of buzzwords that are thrown around a lot. I agree with what Sachin said. The basics of the business remain, right? And this business, we're in the business of risk. Finally, whatever you want to call it, it comes down to simply business of risk. And therefore, all of us, I'm sure in our own ways, are making sure that we're doing all the things that keeps that perspective firmly in place.
Right.
And we're doing all the things that will make sure that, our risks are contained to the extent that they are controllable. External risks, of course, are external risks. So I think technology has been the major new element which has sort of become center stage. It's not that, all of us have been using technology. We've all embraced technology in a big way already. But I think the extent, because many of our businesses, especially those of us who are in retail finance, it's a touch and feel business, right? So it's a lot more about physical contact. That, unfortunately, because of the pandemic, has come virtually to a standstill. And to that extent, the use of technology, whether it's for our employees in terms of work from home or from our customers' side, I mean, these are guys, a large number of them don't know apps and, virtual pay and portals and stuff like that. So one of our big, changes has been to get these people to buy in. Our people themselves were comfortable enough with technology. I don't think it was an internal challenge, but externally to get our customers to sign up for portals or apps or whatever, I think that was the big change. And happily, again, to echo what Sachin said, people have been more than happy to sign up. And we're seeing that a lot of our origination, a lot of our collections are now happening digitally. Again, digital is an overused word, but electronically, let's say. So that's been a big learning for us in terms of just, finding out that so many of our customers, and now I'm asking myself, maybe we should have asked all of these guys 3 years ago, right? Why did we wait for a pandemic to get them to convert to digital mode? But, you live and you learn, as they say. And I think apart from, what it means in the immediate context, what I think it's also taught us is that many of these things are relevant even in the future. So even when things get back to normal, even when the pandemic is behind us, I think there is a lot of sense now in thinking about a partial work from home arrangement, a lot more of digital in terms of sourcing, collections, all of that. So I think it's opened up our minds to the possibilities that exist already. Not to speak of, all the new stuff that will come, but even the existing possibilities, to me, open up a lot of exciting new possibilities.
Very interesting and important thoughts. In fact, yes, risk is there. The business model will not change. Approach is changing. Very good. Good thoughts. So I will move to Mr. Muthuth. I think Mr. Muthuth may have a different perspective here because he has a substantial, segment or the portion of his revenue comes from the gold, and gold is shining like there is no tomorrow now. So, Mr. Muthuth, how are you? Reinventing business model, or you don't need to reinvent any business model because the substantial portion is coming from gold. How's it?
That's just the TTS and even Sachin Pillai said. There was actually no change in the business model actually. The customers are the same. It's only how we get to the customer, etc. is a problem. So for us, yes, 90% is in gold loan. We have very small portfolio in the maybe housing finance, the microfinance, etc., and also the vehicle finance, very small. So I think I'd rather speak about the gold loan sector because there are so many others here who can speak.
Exactly.
So on the gold loan sector, the issue is that this is again a touch and feel. The branches have to be opened and the customers have to come to the branch for this business. So first month we had a big problem from end of March till about end of April, we had a problem, branches were not open. Once branches got opened, things started looking up. Then again, the challenge here was many of our customers are very small customers, 5,000 loan, 10,000 loan. You can't overnight ask them all to become computer savvy and to go digital, etc. But we had something, we did something good actually at that time. The staff who were at home, actually, we were also not prepared for such a thing, which as Mrs. Fernandez said that we were not prepared for such a thing happening overnight. So we were not related our customers to app and all those things. But in the 1 month when people are sitting at home, we actually told the staff to go and get their accounts, bank accounts mapped with our loan account. So that we actually handheld the people, and we have about 80 lakhs of customers there. So 10 lakhs of them we were able to actually, although we had some customers, 10 lakhs of them, we were able to actually map their accounts. So after that, the usage got better. But again, coming back, the usages, etc., can only be for paying interest or paying back money for money. But for two things, they have to come physically to the branch. And that was for bringing the gold, which you have to check, and taking back. So that we did not have an alternative. But then, as you say, digital is the word. So earlier, about 19% of our customers used to transact digitally. Now it is more than 40%. But then, once a branch is open, people prefer to come to the branch, pay the interest, etc. So if it is open, they will rather come and pay in the branch. Otherwise, if not, they can pay over otherwise. But then again, we went one more step. As you said, necessity is the mother of invention. So we went one more step. We thought that we will start something more, which was the loan at home. So our people used to go, big customers, if they call us, request us. Now we have just started going to their house, checking the gold ornaments there, taking it from there, and making the payment also from the house itself and bringing the gold and keeping it in our branch. So the biggest challenge of at least the bigger customers that they need to come to the branch, we have been able to partially solve it. But not everybody is comfortable for us to go to their house and take, etc. But somebody who wants, we are doing. I think that is slowly, in the last 1 month only we started. We are seeing good change, good traction there, especially in the bigger cities. Smaller towns, etc., people still would like to walk to them. This has changed. But one more thing I've learned in this is that we can work with much lesser number of people, especially in the head offices and controlling offices. Instead of 10, I can work with 6 or 5 or that range. So we have actually realizing that we were productivity in the office was much lesser. Now I think not on the branch level though, at the head office and controlling levels, we can work with a lesser number of people also. That is one realization which we have also
Right.
just come to grips with now.
No, very, very interesting thoughts, Mr. Mithut. Minimum government, maximum impact. You need, maximum decisions. Very good. Sounds very productive. Now there are, couple of specific questions I have, and I'm glad that, you opened up and, spoke really well and gave your opening remarks. The question is now to you, Dr. Fernandez. You're not only just an, NBFC, but you're you're into the wholesale lending. You're also dealing with a lot of partners into fintechs and all. What is that you see on the field right now? In your first question, you spoke about the growth, which is the major challenge. But after the 6 months, thinking about the next 6 months, are you seeing the same kind of demand which you used to see a year earlier, or how's it?
Thank you. Yeah, no, that's a very good question. I clearly, I mean, what we have in some sense managed the immediate present. But I think going forward, we will have to manage particularly the risk appetite. And that's really where we see the big challenge, at least from the way we look at the business right now. So for example, the immediate requirements for liquidity that NBFCs faced have been met with. There have been a whole set of actions that were taken by the regulator, by the government of India. There have been a round of TLTROs, then the partial guarantee schemes, and so on and so forth. So there's a decent amount of flow of capital coming from public sector banks and so on into the NBFC space. I would still say that it is more towards the highly rated NBFCs, and particularly the ones that we care about and really try to help a lot, which are sort of the mid-rated NBFCs or even the lower-rated NBFCs. Could do with a lot more flow, but I would say for the moment that problem has been solved. What is really going to happen over the next 6 months and going forward is that a lot of these large PSU banks and so on will hit their NBFC limits. And once that happens is when we will have to really push and make sure that the capital markets open up, the bond markets open up. We see a lot more action happening on really very solid, completely commercial backed flow of debt into the NBFC space, just because the NBFC sector is a very interesting sector. There is a lot of promise there. And in some sense, we will have to rebuild that entire space to build that confidence back. And to be very honest, I don't think the bond markets in India have been top of the world markets, right? Even before the liquidity crisis happened, even before the pandemic happened, I think the bond markets have always had the challenges. We haven't had the deepest or the most liquid bond market in the world. I think that challenge becomes even more bigger now. And I think that's really where we would want to focus. We would want to focus on bringing back that risk appetite, bringing back the confidence into the NBFC space, bringing back some of the investors who are capital market investors, who in some sense will be the ones who will sort of bring that action back over and above, of course, all the good work that the PSUs and the others have been doing. So that's really what, and I'm really looking forward to the next 6 months. Northern Arc in particular has been working in this space for the last 12 years, and great confidence in the ability of some of these underlying sectors and institutions to bounce back through such crises. And we've seen many of those. So great hopes that they will bounce back, and great hopes that investors themselves, in particular debt investors, capital market investors, bond investors, will see the promise and come back to the spaces again.
Very dynamic, very hopeful. Mr. Kanoria, do you buy the hope of Dr. Fernandez?
Definitely NBFCs, it is not that NBFCs are going to become extinct. There would be, every NBFC has been re-engineering, redesigning, and as many of the other speakers also mentioned, that the businesses as normal, some have just changed the way that they have been conducting business. So re-engineering is always a good idea. Reinvention is always good. And either you do it willingly or the environment will force you to do it. But it has to happen. Change has to happen. So therefore, change is always very good. Yeah.
I have a very specific, question here, Mr. Kanoria, and the question is specifically about when you're talking about the challenges in NBFC sector right now. Yes, it added in last 6 months, but the challenges not just happened in 6 months. The challenge was there with the NBFC even before pandemic, and that started from 2018. So how much is the baggage that you are carrying, from the pre-COVID era, and how much we added in the COVID era?
So basically, as it is, many of the companies which have been involved in wholesale lending or infrastructure or equipment financing, they were facing some challenges, and which has got compounded with the pandemic. So I think that now, looking back, if we see it, what can the companies do and what we have done during this particular period? One is to rationalize on the costs, make it more efficient. So that is what has happened. So we have been able to cut down our cost, and because of using technology extensively, and because most of our customers are also now forced to use technology because they cannot go and meet the company people. They cannot meet the employees of the company. So therefore, people are forced to do that. And this has also helped us to reduce our cost. Similarly, many other NBFCs would be doing the same thing. On the asset quality that we need to, all last 2-3 years, everyone has been all of us, we started looking at the asset quality and see that how we can be more focused on the areas where we have the competence instead of expanding to various areas where we may not be having that competence. So therefore, I think that this has been the re-engineering which NBFCs have done, especially at Shrey. We have done that to a very large extent, where we have reduced our infrastructure project finance portfolio by almost 1/3. We expanded our equipment financing. We expanded the equipment financing into various areas besides the construction and mining, into healthcare, agriculture, etc. So therefore, that's been the re-engineering that we have done. And over a period of 30 years, that now that we have been in existence for 30 years, so we have seen that these changes in this re-engineering and reinvention is an ongoing process. Sometimes, as I mentioned, that sometimes it is because of the compulsions of the environment. Sometimes you do it because you think that it is the best way to reinvent yourself.
Right. Okay. Thanks. Mr. Pillai, specifically, if you could give me more, anecdotes here in a commercial vehicles business or in terms of businesses, what kind of disbursals are you seeing? Are you seeing the demand is back, or you are more, looking at the risk aggressively? You're going for more due diligence now before, disbursing any loan?
As you were mentioning, Amol, very rightly, the pandemic set in, 6 months back. But if you look at it from a commercial vehicle financing or commercial vehicle industry perspective, anyway, this segment was going through a degrowth. Since November 2018, we had seen the degrowth setting in on the face of excess capacity and the revised Excel norms, which kind of led to the degrowth. We were pre-COVID, we were expecting the degrowth to continue through first half of this year, largely on account of the transition which happened from BS4 to BS6, and therefore we kind of estimated the customers would go for a wait and watch to see how the technology is playing out and absorbing the cost which is coming thereon. And our expectation, the industry expectation, was that we would see a revival happening post Q3, and then growth coming back. However, with the pandemic, coming in and the lockdown coming in, very clearly this, revival is kind of moved by another 2 quarters at the minimum. And therefore, we do feel that, the current year, and we have already seen the past quarter where, April and May, there were next to nil sales, and then, June from scratch, it again started off. We saw a record degrowth of around 90% happening in Q1, and now things are kind of picking up. If I then go, the way commercial vehicle is a large segment, if we go segment by segment to see how things are moving, obviously, the vehicles which are kind of, linked to the rural part of India, which is less impacted on account of the, infections being low out there, we are seeing a build-up happening. The Rabi crop being good, harvesting being good in May, and the good monsoons which have happened right now. The rural, engine is supposed to kind of, deliver much better than the urban and semi-urban engines. And therefore, we feel we are seeing traction, in fact, picking up for the small commercial vehicle, light commercial vehicle, intermediate commercial vehicle segment picking up right now. On the MNHCV side, with the kind of, orders that we are seeing on the infra side and some mining activity picking up, we are seeing tippers demand coming in. Tippers is the first one to move off the block as far as MNHCV is concerned. In certain, belts in central and eastern India, we are seeing traction picking up. Overall, the haulage segment, we believe, might take another quarter or two, in line with the improvement in consumption trends across the country and the supply chain. Therefore, to manage it, we might see haulage picking up. So very clearly, right now, segments which are linked to intracity, segments which are linked to rural, segments which are, kind of away from the, hub movements and away from the metro and, urban centers, those assets and those, segments are picking up, and we are seeing action coming in and demand kind of picking. Now, on the face of all this, if you look at, there are certain greens, kind of shoots which are coming in. If you look at the way the e-way bills, it's almost at 98% of pre-COVID levels in July. Tractor sales, if you look at on the other hand, it's at around 110% of the previous year. Again, related to rural. Two-wheelers are almost at 90% of pre-COVID levels in July, which kind of augurs well for two-wheeler transportation because entire country's two-wheeler, movement happens through trucks. Small commercial vehicle, as I told you, we are seeing good traction picking up. So in bits and pieces, we are seeing, the traction picking up. However, very clearly, a full-fledged kind of a recovery to possibly the first step being a pre-COVID level, which anyway was a degrowth and then to a growth. We clearly see that it's possibly a couple of quarters away. But what it really means is that, if by end of this financial year, the commercial vehicle segment would have seen 10 straight quarters of degrowth, which means that, there is a, kind of a pent up demand, especially on the replacement side, which will kind of, come in. And that, we believe will lead to a robust growth cycle, most likely from the, first quarter of the next financial year. Till that time, commercial vehicle, the industry as a whole and financiers, need to brace through this period in this current financial year.
Right, Mr. Pillai. In fact, thank you so much for adding those green shoot part also. TTS sir, I will come to you. You are operating in a full-fledged NBFC space. And you also heard Dr. Fernandez talking about the wholesale lending. Mr. Kanoria and Mr. Pillai talking about the commercial vehicle and infrastructure business, how it is shaping up and what kind of demand they are seeing. How do you look at, the business right now for next 6 to 12 months? Because at one side, there are people, those who are applying for fresh loans. And on the other side, NBFCs are saying that we are getting more applications, but we will be more vigilant. And like you said in the beginning, you are in the risk business. So will we be more vigilant going ahead in terms of disbursing loans because you would like to avoid the defaults?
See, I think vigilance is probably more a PSU language. What we call it is prudence. I think as lenders, all of us like to believe that we are prudent because essentially all of us deal in other people's money. So in one way, shape or form, we are all custodians of public money, right? So prudence is basically what guides, I think, all our decisions. Pandemic or no pandemic, I think that's a given. I think what the pandemic has done, however, is definitely increase the levels of risk. Because if you look at certain segments, hospitality, for example, tourism, right? These are segments that have been very badly hit. Yes. So even though your customers in the past might have been very good customers, their records, their credit records were brilliant, today, if they have not operated their businesses for 6 months, and if they are not able to operate their business for the next 6 months, let's say, God forbid, then you've got a situation where effectively, especially if you're a small business, effectively your business is destroyed, right? And it's not just that that business is destroyed, then there's a chain, because there's a whole bunch of people, the supply chain, which sort of keeps this business going, they're also badly hit. So I think we need to be aware of, this is a very sectoral problem, right? There are certain, as Sachin says, e-way bills are back to near normal because certain types of activities have rebounded. Essential commodities, for example, agri-produce, things are more or less back to normal, right? E-commerce is more or less back to normal. So all of that is happening, but then there are some very core sectors, and this can vary regionally. For example, if you're in Kerala, and Alex will bear me out on this, tourism is such a big part of Kerala's economy. So how much is that hit? Or if you take Rajasthan, for example, where tourism is a big part of their economy. So these are factors that are going to play out. So I think we should be careful not to generalize, right? This is very regional. This is also very sector specific. And, the view that we are taking, I'm nobody to advise anyone, but the view that we are taking is that, as they say in the mutual fund industry, past performance is no guarantee of future returns or something to that effect. Yeah. I think as lenders, we too need to look at that. Our past behavior of our customers is no guarantee that they are going to be able to repay in the future. So we need to look at what's happened to their businesses what are their cash flows, what are the vulnerabilities. This is one part. The other part is that this pandemic has also opened up new opportunities. I was very interested to hear my friend Alex say loan at home. So immediately what I'm thinking is for each of his guys to go and deliver this home at loan, can I finance those guys with a small commercial vehicle? Right? So there's an opportunity in this, right? I got a call from the shoe store where I usually go and buy my footwear. The guy sent me his e-brochure, and then he said, you know, if you choose the 2 or 3 shoes and chappals you want, our guys will come home and they will fit you out and you can buy your shoes at home. So when you talk about new business models, I think lots of new ideas are emerging, and out of those new ideas, new opportunities are also emerging. That's one side, but definitely we cannot forget or we cannot ignore the fact that risk has gone up across the board, right? Because I think Shama said this at the beginning. I mean, none of us, you know, I'm getting close to my 40th year in this business. I haven't seen anything like this. So nothing that we have seen before has prepared us for, you know, what we are going through now. So the reality is every day is a learning, every day is a challenge, but every day I think we're also finding new solutions. So this is sort of a sum up, if you like.
Thank you. Very, very interesting. And Mr. Muthoot, I will also take kind of, shift the gear and maybe spin the same question that I asked here, sir. Are you, looking at due diligence very, very seriously right now? Because the market is very different. The people, you don't know whether they will pay back. And also, how are you dealing with the disbursement and the collection? Because initially there were no, employees you had to go and send, them to collect the money and, disburse also because of the due diligence process. So how are you dealing with these 2-3 issues, Mr. Muthoot?
Thank you. But the small advantage which we have is we don't go for any collections. We don't actually need to go for any collections. The customers walk into our office to take back their ornaments. So actually we don't have any collection mechanisms at all. The only thing which I said is that to get the first customer, to onboard the customer, people who are not willing, not wanting to come to the office, etc. is what I said. But for us, collections have not been an issue because people come back and pay. Thankfully, we finance only the gold ornaments, which is used by people. And that is things which is giving us, which is keeping us, our business going today. Because we don't have the problems in the other lending space which we have. But again, as you see, the gold price actually has gone up. And that is also something which can come down also. So that is a risk which we always have in our mind, but then we keep some margins for that. We keep some margins for that. So for business change we have done is that, yes, we are also now, as TTS said, we are prudent. We will see that we are actually, yes, he said it correctly, very bluntly, that we all deal with other people's money. And I think we're more responsible when we deal with other people's money than your own money. Yes, we are custodians. He said it right. So we are also careful in that sense that we don't take undue risk. We keep good margins when the price is very high. Actually, we are permitted to lend up to 75%. But today our lending is only an average of 55%. So we have a 45% margin with us. But that margin will come down when the gold price drops. But then still we have a good elbow room for such things with us. And thankfully, our loan is also very short term. The average tenure is only about 4 months. The difficulty here is that I have to get new customers. In 4 months, my whole book goes out. Right. The whole asset goes out. But then these people have to come back again, and that is what keeps us. People still come back to us for taking this loan because we have made it very customer friendly. But today we are actually having a lot of competition. Right. Competition from all the banks. Every bank worth its name today is starting gold loan, and every advertisement is gold loan at that person, this person, 4%, 4.5%, 5%. So we have to deal with that, and I think that is a challenge which we have always felt, and we will have to deal with that, because it's not just the interest which makes people to come to us or to any other bank. It is many other things. So we try to see that we give that comfort and convenience to the customers, so that, but because of all these advertisements, etc., and gold, more people are now thinking of taking a gold. The market is improved. Today, actually, the gold with all the people is about 25,000 tons, and only 3,000 tons is in the organized gold loan market. There is still 22,000 tons with the Shema and the TTS and all these people. They all have all these gold with them, 22,000 tons. So one fine day that will also come to the gold loan market. That's
right. Let's hope that
banks
comes
are
to the market here.
That's one thing which we see. Of course, some business will go away from us, or new business, but then more people get inclined to gold, because it always has a little bit of hesitation for people to pledge gold. That inhibition is going away now, because even all the big banks are doing it. It is not a pawnbroking anymore. It is a good standard business. That's the advantage which we see because of this. The competition is a big challenge for us today, actually.
Okay, thank you, Mr. Muthu, for that. So I obviously know that we do not have a crystal ball and we cannot predict the future, but you are being the leader, and I will have to take this question. Because earlier when I was working for a TV and I used to go on a field, and when I used to tell somebody that I'm a business journalist, the first question that I used to encounter was, okay, which are the stocks that I should buy? Tell me quickly. So that is the question that the people used to ask me. But now when I speak to anybody, the only one question everybody wants to know is, how do you see future? What leaders tell you? What is going to happen over 6 to 12 months? So this is the same question. I will tweak it a bit. And Dr. Fernandez, like you said in the beginning, once the limit of the banks is going to get over, then it would be really difficult for the NBFCs to raise the funds. I can see a lot of banks are raising funds. In fact, everybody is raising more than 10,000 crores, 50,000, 15,000 crores. How do you see the challenge for NBFCs when the limit of the banks, is locked? And what are all the options? Because we also know that the bond market is also not the better option for NBFCs to raise funds. So how do you see that situation going ahead for NBFCs?
That's right. So I think it is going to be challenging, and I think the earlier we recognize that, it's not the end of the world. None of us are shutting shop and going anywhere, and we are going to continue our business and continue it well past, past the pandemic. So I think really we have no choice but to make sure that we kickstart the bond market. And it is not easy. It is extremely challenging. And I can tell you the conversations are getting tougher and tougher at this point of time. But, maybe it's just pure experience. And while we all agree that we have never been through something like this before, I think we've been through crisis and we've kind of come over them. My sense is the only way to do this is to, kind of persistently go behind trying to kickstart the bond market, to try to get other investors who are coming into these spaces for the risk return reasons, commercial investors, overseas investors, capital markets investors. I don't even want to start talking about the mutual funds. But we're going to have to do that because there is no other way to really do this. So that's one big pool of, I would say, debt capital investors that we really need to bring back into the market as PSU start hitting, their NBFC limits. And just from sort of a business model perspective, from a diversification perspective, it's never a good idea to depend only on one class of investors. So we should be doing this anyway. So I think that's a big challenge. I think another important, I'm not saying it's a challenge, I'm just saying that this is something that we're going to have to work towards, is really making sure that the equity interest in the NBFC sector continues, and probably, for those who are looking at it sort of from a long-term perspective, this is a great opportunity. There might be some really brilliant deals right now available in the market, and to really bring back equity investors to make sure that there is enough risk capital backing these sectors through this time will also be very, very important. But, my really perspective is that if you're looking at the market from a 6-month lens, from a 1-year lens, it might actually look quite depressing. But if you're really looking at the opportunity that India offers, particularly to NBFCs and what they really specialize in doing well, then I'm looking at this as a very, very big opportunity. And I see no reason why we can't attract capital. Of course, I suspect the valuations will be a different story. I suspect NBFCs will not operate at leverage of 6x and 7x and so on and so forth. So I think all those expectations will be reset. But I think these are the two big pools we need to go after. One is bond market / debt capital market investors, and two is very strong equity investors to back the NBFC space.
Right, Dr. Fernandez. The watch is ticking, but I will quickly finish this round of questions because this is very, very important. Mr. Kanoria, tell me quickly, yes, we have seen some uptick in the demand, but your sector is, that you are catering to is very, very important, infrastructure and equipment finance. I would like to, put the question in this way that, what is that the corporates, the NBFCs, the financial institutions, or in general, the government should do to generate the demand? Because everybody wants a demand right now.
For our sector, especially on the construction and mining and infrastructure sector,
right,
where is the biggest problem? The problem is that because they are primarily, all our clients are doing work or participating along with the government. The disputes with the government, if someone gets into it, it is a long drawn process before they get their money. Their arbitration award which are stuck up for years. So if this unlocking of funds by the government, which is there caught up through disputes and arbitration awards,
right,
and all these various myriad of problems, that is addressed by the government, then the construction companies, the concessionaires, they will start getting some liquidity. There will be unlocking which will happen. And when the government is coming out with new contracts, they would be then geared up to participate because they would have enough liquidity. Today, what has happened is, unfortunately, many of the companies have got into a catch-22 situation. So they are in a vicious cycle. So because they do not get their payments on time, because there is arbitration award which are stuck up, so what we have been trying to persuade, convince, beg the government is that please unlock whatever money is locked up with you. And that would be the first problem and alleviate the problems of the contractors, the construction companies and concessionaires. So they are enabled enough to be in a position to participate in new projects. And that is where we see that then the demand will start picking up. So we have to move out from the vicious cycle and transition to the virtuous cycle.
Very, very important thoughts, Mr. Kanoria. Mr. Pillai, what do you think will, pick up the demand specifically into commercial vehicles? And also, partly if you could answer me, because you started, and made a very important point of the technology and digital, what part of business will go on digital? I'm sure the 100% will not go there, but in terms of your business.
You see, Amol, as I had mentioned, most part of our customers that we look at are self-employed, unorganized customers at the bottom of the pyramid. And therefore, these customers, their adoption for technology is something which, while we have seen, movements happening in post lockdown, but it's really one needs to see how it will kind of continue. And to that extent, as TTS sir was rightly mentioning, the touch factor of this business will always remain. It's so much in the overall customer, life cycle that we can kind of digitize, but touch will remain. Cash is an important factor as far as repayments are concerned from these customers, and therefore to that extent again touch becomes important. However, on a go forward basis from where we are right now, we're kind of pretty hopeful that many of the vehicle categories, as I had mentioned, we do see kind of growth coming back. Obviously, the good monsoons, which have been above normal and more importantly well spread. In fact, the best in the recent years that we have seen, relatively in a kind of low spread of infection in the semi-urban and rural areas. Resilient consumer sentiment that we are seeing in upcountry markets are creating a conducive environment kind of to a bounce back to happen. Hopefully, the festive spirit and the positive consumer sentiment, along with the impact of the policies and the government measures, which should be felt in the coming future in terms of demand revival. For us, partnering with our stakeholders such as OEMs and dealers to do all possible from reviving demand, reaching out to potential customers from both our internal sources as well as open market, engagement levels with dealer partners, especially training their staff to work along with our field on digital platforms and digital interventions are kind of being well received. We have also seen OEMs repositioning themselves during this period. For example, Ashok Leyland, our parent, went ahead and launched their, AVTR or Avatar modular platform, which will basically provide flexibility to customize vehicles in line with the usage. They have come out with around 6,000 combinations, which brings in standardization of body types to allow customer to put the asset to use on a faster mode as compared to conventional method. So, we are seeing these changes happening in the market, which is kind of, aimed at, reviving demand. Whether it will happen on an immediate short-term basis or on a medium to long-term basis, one need to actually see how the, pandemic, kind of plays out. Obviously, here the assumption is that, we are not going to see possibly, or we are not going to see further lockdowns or kind of, second round of COVID coming in, etc. not happening. We might see a gradual pickup, which will happen.
Very, very interesting, Mr. Palle. TTS, sir, there are traditional bankers, those who are in the business since really long, are saying that we are evaluating the SMEs, MSMEs, and the borrowers on a case-to-case basis. And here you are differentiating them and telling them that, okay, we should not look at the background, but we should look at the future and the potential. Considering this view, sir, how are you seeing the next 6 to 12 months specifically for your sector?
We are not in a sector that's different from anybody else because we tend to finance, mostly vehicles, which is heavy commercial vehicles, light commercial vehicles, fast cars, tractors, the whole lot. So it's not, we don't operate in a different universe. My own sense, and I've said this before in interactions with the media, we live in a time where to plan anything more than 1 month ahead is really, crystal ball gazing. So that's all we're doing. We're actually doing plans by the month. Honestly, I don't know what will happen in Q3. We hope for lots of magic to happen, but the reality is that our planning cycle now is exactly 30 days. And if we get that right, we celebrate, right? So I think that's where we're at. So I think it's important for all of us to understand that this year, to be talking about growth over last year is, to me, fanciful. I think the realistic conversation is how minus will we be?
Right.
As Sachin said, when we started in April, it was minus 90. Will we end up at minus 30 or minus 50 or minus 20 is the conversation. I think we should certainly be optimistic, and I'm with Shama on that. I think we're all invested in the India story, right? Of course, we believe over the next 18, 24, 36 months, we will be back on track and, we will be really rocking, as they say. But the near term, which is 6, 9, 12 months, I think will be a rough phase. We have to climb out of this. But if we do it right, if we are prudent, if we don't do stupid things, I think most of us will come through this, right? There will be some scars, there will be some bruises, but I think most of us will come through this with valuable lessons learned and hopefully well prepared then to sort of take advantage of the next phase of growth, which certainly is on the horizon. We can't see it just now, but I'm sure 12 months out, 18 months out, the conversation will be a very different one. It will be a very optimistic one. But right now, I think this is a time to fasten seat belts and hang on, right? Because the ride is going to be bumpy, and it's best that we don't pretend that it's not going to be.
Okay, very good. Mr. Muthut, taking cues from Dr. TTS, I will ask you, how are you going to save yourself from the bumpy ride? How are you going to, protect yourself, because your segment is very volatile?
For us, protection, we have to keep our safety margins. That's it. Seeing high gold price, we should not lend too much on the safe.
Okay.
That's one of the things we learned. But that is, I think, that is what we in the gold loan sector should be doing. And I think we have our association of gold loan sectors also. We have been doing that. Recently, the Reserve Bank of India increased the loan to value for PSUs, the maximum they can give on gold loans from 75. We were also having 75%. They increased it only for banks to 90%. I do not know whether any bank is lending at 90%. If I were the chairman of a bank and that bank got a permission to lend up to 90%, I would never do it. I would never do it, because even 75% is still a tough thing, because we have to be on our toes even with the 75%. With 95%, I don't know. But of course, it is the wisdom of the regulators to do such things. But we were only unhappy that we were distinguished between a bank and this. Otherwise, I wouldn't want, honestly, our association also wouldn't want more than 75%. We don't want it. And I'm sure many of the, as you TTR said, prudent bankers wouldn't do the 90%. That's what I see. But if I have 2 minutes, I would like to add two things. It's not about our sector, but it is what the government should be doing. The government should actually, as Mr. Kanoria said, they should actually start pumping in money into the system. That can be one, as he said, release all this, unlock all the things which are tied up with government, etc. Most importantly, government should actually start infrastructure. See, we have a metro in Cochin. The moment the metro construction started in Cochin, such a lot of activity happened here. Such a lot of activity happened here. It's same everywhere. So you have infrastructure, whether it's a metro or big highways, roads, etc. If you have highway construction, all this transport sector, Ashok Leyland and TTS, etc., will be singing. Their business will go up. The customers will get, the people will get money. What is government doing with $550 billion with them? They should actually give it out and use it here. It may create an inflation initially, but that is nothing. You want people to die and you say without business, without money, you want the business to die and keep 550 crores with you, 550 billion with you. Use it here, give it to the infrastructure. It will create inflation, but that will be nothing. That inflation will be nothing because the GDP will go. This is what I feel. Infrastructure should be encouraged. The real estate is in doldrums. Last 2 years, it's in doldrums. Government should give its own land and ask people, construct poor people houses. 50% of the land of the construction cost, government should subsidize. 50% people should give. The NBFCs or the housing for NBFCs can give that 50%. The land should be government. Today, why is the cost of a building very high? The land cost is the killer. The construction cost is only 1,000 or 1,000 rupees per square feet. But when you go and get it, it will be 5,000. The 4,000 rupees is the land cost. So if infrastructure, building houses and manufacturing, make in India, etc., things our government is saying, but they should actually put it into practice. Put purchasing power in the hand of people. When you put purchasing power in the hand of people, everything will change. Everything will change. Today, everybody is spending only for essentials, nothing else. TTS fortunately bought a shoe, but how many people are buying shoes today? Nobody. They are only buying only essentials. That should change.
Right.
That's my feeling. Of course, I am no economist. It's my experience.
No, but I think everybody can echo with your feelings. It's a very, very valid points, and thank you so much for raising it. Always happens sometimes when you talk about government, those are some important decisions that the government should do and take. In fact, I have been listening a lot from the industry that even GST refund is pending, tax refund is pending. If those comes to the picture, I think things will change. Wish I could have, extend this conversation and spoken to you more, in fact, and ask you more questions. But unfortunately, I don't have enough time. But thank you so much for sharing your, I must say, remarkable views here, not only about what is happening right now, but what may happen in near future with whatever a little prediction. So thank you, Mr. Hemant Kanoria. Thank you, Dr. Fernandes. Thank you, Mr. Pillai. Thank you, TTS sir. And thank you, Mr. Muthoot, for the remarkable insights. And thank you so much for joining on ETBFSI Converge.
Thank you, gentlemen, for such an engaging discussion. I would like to bring to your notice that the exhibition booth at the expo area are definitely worth a visit. So make sure you check out our partner booth to know more and how you can make your business future ready.